Welcome. For 3 decades, I've watched the world's brightest minds analyze corporate finances, and most of them are looking at the past. They read a balance sheet like an accountant, checking for solvency and safety. Today, I'll show you how to read it like an engineer, looking at a power plant, ready to unlock its true potential. The conventional wisdom tells us to seek safety. We're taught to admire the fortress balance sheet, a company overflowing with cash and carrying zero debt. Analysts praise this as a sign of health and prudence. They treat the balance sheet as a static snapshot, a historical document to be examined for signs of past stability. This approach is comfortable, it's familiar, and it's fundamentally backward-looking. It's the financial equivalent of archaeology, digging through the past to find comfort, while completely missing the indicators of future growth. But here is the provocative truth. That celebrated fortress balance sheet is often the single greatest barrier to creating generational wealth. In my experience, an excessively conservative balance sheet isn't a sign of strength. It's a leading indicator of management capitulation. It signals a profound lack of imaginative reinvestment opportunities. This so-called safety is actually stagnation. The capital is secure, yes, but it is also imprisoned, unable to work, grow, or generate the returns that build empires. It's a sign of a company that has given up on innovation. So we need a new model. I propose we stop seeing the balance sheet as a snapshot and start seeing it as a dynamic energy transducer. Think of it as the core engine of the business. Its primary function is to convert raw capital inputs into powerful future-free cash flow outputs. The game isn't about having the most assets stored in the vault. The game is about achieving the highest velocity of capital transduction. We're looking for companies that have engineered their finances to use capital, especially other people's money, with maximum efficiency to compound their own equity. It's about flow, not accumulation. To measure this velocity, we need a new framework. Let's set aside standard ratios like debt to equity for a moment. They often obscure the real physics of the business. Instead, we'll divide capital into two states, potential and kinetic. Potential capital is the cash sitting in treasury bills. It's safe, but it's ossified, inert. Kinetic capital, on the other hand, is capital actively moving through the business cycle, constantly working to generate returns higher than its cost. Our entire analytical edge comes from identifying the mechanisms that transform potential energy into powerful kinetic results. Let's look at the first kinetic mechanism, which traditional analysis views as a major flaw. It's the negative working capital turbocharger. Standard analysis penalizes companies when current liabilities exceed current assets. But many of the greatest compounders operate this way by design. Think of retailers or subscription models. They collect cash from their customers before they have to pay their suppliers. This creates a permanent, interest-free loan from their own supply chain, known as float. This isn't a sign of distress. It is the ultimate form of leverage. They are using vendor money to fund their expansion without diluting equity or paying a dime of interest. The second mechanism is another accounting liability that is actually a massive hidden asset. I'm talking about deferred revenue. On a standard balance sheet, this is a huge liability. But think about what it represents for a high-margin software or subscription business. It is cash already in the bank for a service to be delivered later. It's highly probable future revenue. It's a liability in name only. When I analyze these companies, I mentally reclassify about 80% of their deferred revenue from a liability to equity. This simple shift reveals the true economic leverage and health of the business model. Let's see this in action. Consider Amazon in its hyper-growth phase, from roughly 2005 to 2015. Traditional investors avoided it. They saw low profits and a weak balance sheet. They missed the engine. Amazon ran a massive negative cash conversion cycle. They sold a book, held the customer's cash for 60 days, and then paid the publisher. They used that float, that free capital from suppliers, to build the foundations of AWS and their fulfillment empire. Their balance sheet was a high-velocity reactor. Now contrast that with a lazy industrial corp sitting on $5 billion in cash but with an ROIC of 6%. That cash isn't security, it's evidence of a failed strategy. It is a value trap of potential capital that never becomes kinetic. So how do you find these kinetic engines? You must adjust your screening criteria away from static safety and towards dynamic velocity. First, screen for companies with consistently negative cash conversion cycles. Look for businesses where days payables outstanding is consistently higher than their days sales and inventory outstanding combined. These companies are literally self-funding. Second, use a metric I call the float ratio. Calculate the sum of accounts payable and deferred revenue and divide it by total assets. A high and rising ratio indicates a business that is masterfully funded by non-interest-bearing operational float, rather than costly debt or dilutive equity. Ultimately, it comes down to a final, simple question you must ask before you invest. Is this management team hoarding capital to protect their jobs, letting it sit as dead potential energy? Or are they acting as master engineers, rapidly transducing every available input into higher value outputs? Always prefer the latter, even if the balance sheet looks superficially uglier to the untrained eye. Stop reading balance sheets as history books. Start reading them as blueprints for the future. See the engine, measure its velocity,